fact, we're going to continue this conversation right now. For more, I want to bring in Michael Lasser, retail analyst at UBS. Also, Marianne Bartels is here, Bank of America Merrill Lynch's head of Research Investment Committee, also the head of ETF strategies. But, Michael, let's start with you on this Walmart news. How much, again, and we talked about it last hour, do you look at this as a Walmart story, or do you look at it in the larger context of the consumer, the American consumer being stronger than perhaps the markets have been giving it credit for?
Good morning, Andrew. That is the key question, and we would attribute more of this to Walmart. But with that being said, the consumer is in good shape as we speak. The unemployment's at a 50-year low, wages are rising, and that is feeding into Walmart's results. But they comped the comp this quarter, meaning they did particularly well last year. They also generated margin expansion in the core U.S. business, and they raised the guidance for the full year, saying, despite all of the uncertainties, and as far as the eye can see today, we got this. And the market is responding favorably to that confidence today.
But should the market be responding not just favorably to Walmart, but for the other retailers that they're out there, to the extent that people are looking at the broader economy, should they be saying to themselves, okay, actually, like, we got this, meaning we all have this? Or do you think this is a single stock story?
This is Walmart exhibiting a lot of strength. This is Walmart definitely managing through a very difficult environment. It's important for the market to differentiate between winners and losers in retail, because this is not going to be universally seen in all of the results that as we get through reporting season. Walmart is showing strength. Others will show strength, but there's also many who are going to show weakness.
Marianne, what's your takeaway? On these earnings relative to the larger picture of these markets this morning?
Well, yesterday you had Macy's report, and according to our analysts, that was a disaster.
It was a disaster.
But that's apparel. Walmart is a grocery store. It tends to be a little bit more defensive. Our credit card data, that's proprietary to Bank of America Merrill Lynch, is still showing the consumer spending money. But we also recently had Amazon Prime Day,
right,
and that really impacted the numbers. But what we recently took a look at was when you get an inversion in the yield curve, what's the sector that's most negatively impacted? And that turned out to be consumer discretionary. And retailers are in consumer discretionary. So if we are slowing down and if the consumer eventually slows down spending, the risk is that the sector that will have the biggest impact is discretionary. But what's then the signal?
What's the sign? What are the numbers that you're looking at? Because people are looking at the 2 and the 10 as one side, and then they're looking at the consumer and the employment numbers on the other, and they're trying to make sense of it because it doesn't make sense right now.
So we're talking about the 3 C's. So our strategist, Michael Hartnett, is talking about the 3 C risks. It's China, it's credit, and it's the consumer. So what you're really bringing up is a main point. If the consumer is able to continue to be positive and spend, our economy will be able to hold up. Should the consumer, with all of these headlines and with all the volatility in the market, become a little bit more cautious and start holding down spending, that's going to have a more negative impact on the economy. But the point that we're trying to make is we're moving into the most seasonally volatile period of the market, and we continue to expect what we call episodic volatility as we move into September and October. So we don't think the volatility is over.